This week, as part of Learning Saturdays, we bring to you 3 very interesting webinars. At 10 a.m., we have Save Like an RD and Earn More Than an RD, Power of SIPs Over the Long Term. This webinar will also be done in Tamil at 12 on our Tamil channel. And at 11 a.m., we have a webinar on the power of rebalancing. Don't miss out on these webinars. This is your time to learn and stay ahead of the markets and get an experience of what we do. Register now using the links in the description below. See you all there.
Welcome to this video for ithought Connect. Have you been thinking that it's been a little bit more difficult to invest today? That there don't seem to be that many good options for you to put your money in? Or that you're quite confused about what is the right decision to make today? Some of us are thinking of stopping our investments, others are pausing and waiting for more clarity, while some are just continuing their investment. So what is the right thing to do in this context? Has it actually become harder? Now, when we look at the data, it has become a little bit harder, and I'm going to tell you 3 reasons why investing got harder in 2025 and what you can do about it as an investor. So the first reason that we're going to look at is the economic cycle. So if we think about where we are in the economic cycle and what happened in the past, then we get a better picture of why things are getting a little bit harder now. So if we study how economic growth has been, prior to COVID, the Indian economy actually slowed down and it needed some level of stimulus. Then you had COVID and that coincided with a global standstill, right? And from there, you had a sharp economic recovery or your K-shaped recovery, which meant that different segments recovered at different rates. And when the K-shaped recovery happened, you had growth come in a spurt. At the same time, you had pricing power because there was a lot of revenge spending, there was a lot of coming back or order backlogs which got fulfilled. So companies had more pricing power, and this meant that margins actually could expand in this phase. But as we know, nothing can go on forever. So even this growth as well as this margin expansion had to come to a reversion to mean, right? This means that what we saw in the last 4 years, that is, let's say from 2021 to 2025, has been a very positive cycle. And now some of those key drivers have actually changed in nature. So you're definitely seeing a slowdown in terms of economic activity. You're also seeing margin compression or stability for many companies. So now investors are tasked with the responsibility of assessing and seeing whether these valuations are justified. So would you pay the same amount of money for a company that was growing both its profit pool as well as its sales versus a company that's not able to grow as fast as that? So when you start thinking about things in this framework, you will realize that it's harder to make these choices, and that is one reason why investing has been difficult. This brings us to the second reason, which is about valuations and flows. So we did talk about how the valuation cycle is playing out in terms of whether you want to pay the same price for a company that's not growing as fast as it used to, or that's not creating profits at the same pace that it used to. So when the underlying business or the fundamentals of the business have changed, possibly the valuations also need to revise to reflect the fundamental reality. But the interesting thing or the complicated thing that has been happening in Indian markets is, of course, related to flows. So domestic institutional investors have been big in this market cycle. So every time you saw markets correct a little bit, you would have DIIs step in and buy the dip. Last year, we had a lot of FII selling going on, but DIIs were able to match with that level of buying. So what you've actually seen is a shift in ownership or stability in the market due to flows, right? So when flows stabilize the market, we really need to be a lot more careful about valuations because flows can reverse at any point, and there aren't clear triggers as to what that reversion point can be. So for every investor, you need to balance both risks in the sense that you do have flows-based investing, and if you completely step out of the game, then you're going to miss out on participating in the equity market rally. At the same time, if you put all of your money in, you could be caught off guard at the wrong time in the cycle. So as an investor, the approach should be more measured, more staggered, and more directed towards businesses where there is more high conviction. The third reason why it's become harder to invest is that your safer alternatives are losing their shine. So previously, if you were a fixed income investor, you were at a higher interest rate. It made sense to lock in to long-term returns. It made sense to take duration risk. You could even look at credit risk as an option. In today's context, with rate cuts largely behind us, with the mega rate cut that the RBI announced last week, it's very clear that there is a shift in terms of what your return expectations can be. So if we look at fixed income, the duration risk is not really so attractive to take today. At the same time, your forward returns from shorter term instruments are not so attractive either. So an investor is caught in this place where returns are not attractive no matter where they look in the fixed income environment. Then if we move on to other safe haven assets like precious metals, even there you've seen a lot of recent performance which has investors questioning whether it makes sense to jump into this bandwagon now or not. I think the most important takeaways from whatever we've discussed so far are that investors need to lower their return expectations. They need to take a more staggered and measured approach to investing. And they also need to be very focused on doing a bottom-up approach to investing. So if you can get these three things right, your investment journey is going to be a lot smoother. And we wish that your investment journey is a lot smoother. If you're looking for a professional partner, then you can write to us at 9500027285, and we'll be very happy to help you on take the next step in your journey.